Hello, everybody, and welcome. We're going to begin in a few seconds. We're just waiting for a few more people to join. Okay, I think we'll get started. Good afternoon. Hello. Thank you for accessing our webinar. My name is John Byrne, and I'm a merger and acquisition advisor with the NYBB Group. And we are seeing right now a lot of activity in the healthcare marketplace. Today, we're looking to advance the conversation about how healthcare practice owners prepare to sell their practice. Today's discussion is particularly relevant for practice owners seeking to sell medical practices, physical therapy, chiropractic, podiatry, optometric, urgent care, and behavioral health. But beyond just the sellers, I think those individuals interested in purchasing practices, practice owners looking to expand through acquisition, will also find this discussion useful in understanding the process by which practices are prepared for sale. This webinar is being recorded, and it will be available through our YouTube channel. For those who are watching live, you'll have an opportunity to ask questions throughout the presentation. You'll notice on your control panel a Q&A button, which you can hit and then type in a question. Later on in the program, I'll read those questions that are put into the Q&A, and we'll give them to the panelists to answer. Finally, following the presentation, we will make available to everyone the contact information for the panelists so that you also have the opportunity to ask questions after the program is over. Now that we're beginning, I'm going to ask the panelists to introduce themselves. And I think we'll start with Erin Hoffman. Erin, can you introduce yourself, please?
Thank you, John. It's a pleasure to be here with you all today. My name is Erin Hoffman. I'm a financial advisor at Certified Financial Services. We're located in Paramus, New Jersey. I can work with business owners throughout the country. I specialize in partnering with healthcare professionals on helping them to protect, grow, and exit their practices. My mission is to help business owners avoid financial failure and to communicate complex financial concepts, investment strategies, estate planning considerations clearly and concisely, and tailor each of these recommendations to each practice, specifically around succession planning strategies to promote tax efficiency and the healthcare space. And I'm very happy to be here today with you all.
Thank you, Erin. And Len Garza, can you introduce yourself, please?
Hi, John. Yes, thank you, everyone, for having me. I'm Len Garza, founder and principal attorney at Garza Business and Estate Law. And we represent all types of businesses, but we do place a large focus on medical practices and physicians, specifically looking to sell and also acquire practices. So regarding sellers and acquisitions, review and evaluate letters of intent, term sheets. We also assist sellers and purchasers in conducting and responding to due diligence regarding those transactions and help review and evaluate practice agreements, corporate documents, leases, real estate that's associated with the transaction, and all other necessary documentation. And we do that with the focus not only on the business aspects, but with a healthcare specialty focus to make sure that we're accounting for the myriad federal and state healthcare laws that bear on those transactions.
Thank you very much, Len. And Lou, I'm going to ask you next to please, did I stop the share? No.
I broke the slides, John.
Oh, sorry about that. Okay. So Lou, can you talk a little bit about yourself, our firm and how you work with practice owners.
Yeah, absolutely. The slide just got up though, so if you wouldn't mind as I'm talking, just get the slides up. Well, welcome everybody. Erin and Len, thank you so much for participating in this, and John, thank you for moderating. My name is Lou Della Prida, and I'm a managing partner and principal at the NYBB Group. Our firm was founded in 2003, and we're a full-service boutique merger and acquisition firm that specializes in the confidential sale, acquisition, and valuation of small and mid-sized businesses, privately held businesses usually, primarily on Long Island, but increasingly throughout the metropolitan area, and in the case of healthcare throughout the country. So I've been advising healthcare professionals for over 21 years. I started my career at JP Morgan as an accountant and a financial analyst, and from there I became a financial advisor around 7 years into my career. In that capacity, I worked with a lot of physicians on their financial plans, insurance, investments, and medical malpractice. And then from there, I became the chief operating officer of a multi-specialty group that I helped grow through a series of acquisitions. And then in the last 7 years, I've been working with the NYBB Group. I became a partner a few years ago, and I head up the healthcare M&A team and work side by side with John, helping primarily ambulatory practices. So we've done some deals in the medical space. We've represented physical therapy practices and chiropractic offices. And then beyond ambulatory, we've also done some work on durable medical equipment and so on. I'm very, very involved with the Urgent Care Association. So besides having run one, I've also been a member of the Urgent Care Association and the Northeast Regional Urgent Care Association. So I'm very excited to be here.
Thank you. Okay. Now moving on. I'm going to go back to Erin and pose my question to her. I'm sorry, is there an echo?
I hear a bit of an echo, but.
Okay. Erin, you work with a lot of healthcare professionals. How do you respond when a healthcare practice owner tells you that she or he wants to sell their practice?
Thank you, John. The first step of this process is I want to be there to help the business owner to navigate this, and I want it to be as productive as possible. So first, I want to see if they have a strategy in place, right? Do they want to stay and work? Does the practice owner want to get out? I really want to work to identify the business owner's objectives. Then I want to navigate if they can afford to retire, right? Really quantify the business and what the goals and values are. I also want to identify if the practice owner has a team of advisors, right, which we'll get into a little bit more, who work specifically in mergers and acquisitions, who can help navigate this decision. I will also want to know if the practice owner has had a business valuation done, right? What's the business worth? This is going to help maximize the company's value. I also want to make sure it's protected in the best way, and really build a customized plan to build value before we even get it ready for the exit plan. Then I also want to dive into then the actual 8 ways to exit a business, right, which we'll dive more into. And ultimately that would lead to their personal wealth and estate planning for the practice owner themselves, right, and getting into legacy that they leave behind.
So, Erin, the way that I'm hearing this, it sounds like this conversation is part of your overall relationship with your client, okay?
Yeah.
That you've already know these people pretty well. They're bringing up to you that now's the time, okay? And you'll also be with them even after this is over.
Correct, John. And I even start speaking about this with the practice owner 10 to 15 years down the road of just broaching that topic with them, right? Because we know we'll have a longer runway that way. And there are about 5 critical elements that I always want to target right off the bat. The first being a target departure date, right? What is the roadmap that we have, right? We want to know when we're planning on departing from the practice, right? That's going to help us visualize a future and get us started. Second thing that I want to do with them is a preliminary financial needs analysis. I think any comprehensive exit plan needs this in place. That's going to help us set and assess our financial wants and needs. It's not going to tell us how much money, right, that we would receive from the transfer, but rather how much that we'll need, right, for lifestyle going forward from non-business streams. The third thing that I want to also speak with them on is starting to think about targeting that successor, right? Who's going to be running the business when they're gone? Is that going to be a family member, a co-owner, an employee, or an unrelated third party? So we want to start identifying who that successor owner is going to be for that initial planning meeting. Then moving into a preliminary valuation, right? We want to know what the business is worth today. We want to get it kind of cleaned up and ready to go there and have a reliable idea of how your business will contribute to those financial goals. And then finally, doing a future cash flow estimate. That cash flow is our most precious financial resource as a business owner and an individual, and that's going to drive our current income for the business. It's also going to fuel our continued ownership and ultimate departure. So really important to make sure that we have that buttoned up and an estimate in place there.
Thank you, Erin. And I think now I'd like to switch to Len. Len, among the transactions I've been involved with, I've been involved in some transactions where the attorney is only contacted when we're pretty far down the road, okay? And that, frankly, has caused problems for us. Can you tell me when should a prospective seller, someone planning to sell, when should they be reaching out to an attorney or their attorney about their decision to sell their healthcare practice?
Thank you, John. And this, I think this really ties in well to what Erin had previously mentioned. You know, most of the time when I get involved, unfortunately, I wish it were earlier in the process, but it was, I hear the phrase so many times, oh, I am the other side, you know, not represented by counsel yet, but I am the other side, I am the other physician. We've already got the essential terms down. We just need you to draw up the agreements, right? And so that is really not the optimal way I like to go into it. You know, more optimally, I like to talk to the doctor, for example, in the case of a selling physician, before the term sheet, before the LOI, because typically I find that physicians, when they're looking at that, they have their eyes on the payments, how those are structured, and maybe employment at the end of the deal, which those are two critical parts of it, of course. But there are also many other subparts to that that are important to the structuring that need to be discussed beforehand and negotiated before we're at the altar, so to speak. And it really makes a big difference as well when I'm talking to the physician to find out, you know, in that initial call, how long have you been thinking about exiting or selling your practice? Who are your other advisors? Who are you talking about? And when that physician gives me strategic responses to those questions, responses to some of the issues that Erin just brought up. Oh, you know, we've been looking at this, you know, for a few years, or oh, I've been talking with my financial advisor, if they even have a financial advisor, to make sure that my cash flow and other things are as attractive as possible for the business, to make sure I can get the highest price upon sale. That really lets me know that we've got a sophisticated seller or purchaser that we're going to be in position, best position to do right by them and get the highest value. And speaking of value, getting a valuation is critical. Absolutely important. I mean, this is an important thing that you shouldn't leave the value of your practice to a back of the napkin calculation. I mean, you need to get an outside independent firm that specializes in this area, specializes in healthcare specifically, that can get you a concrete valuation or an idea of what your practice is worth to go to market.
Thank you, Len. And so basically, I think your messaging is people should be contacting their attorney, their legal advisor early in the process. This should be part of their planning, even before they're actually soliciting offers or talking to prospective buyers.
Ideally, yes, ideally, John.
Right.
Now, Now I come in later at the process as well, but to give you yourself the best chance for success, the earlier you get me and your other advisors involved, the better.
Good. And I'm glad that you put in the plug also, Len, for the other advisors too, because I think it's important to assemble that team.
Absolutely.
Great. Lou, can you explain a little bit about the work of the M&A advisor in the decision to sell the practice and then in implementing that decision, really what we do?
Sure, John, thanks. And thank you, everybody. So, I've done quite a few of these webinars, and every one of these webinars, we stress the need to prepare and the need to educate yourself. And it's almost very similar to when you go to a doctor and they tell you that if you drank 8 glasses of water, got 8 hours of sleep, and ate fruits and vegetables, that your life would be so much better. Everybody knows that this is what you have to do. Everybody's encouraged to do it by their team, and almost nobody does it. And where that's really important is when you look at the type of practices that we help in the lower middle market, especially, right? So typically the client that we work with is a physician, usually owned, the practice may be owned by one, maybe a maximum of 2 or 3 physicians. The practice is usually the largest asset for all of those physicians, right? And so what often happens, in fact, in the vast majority of cases that I work with, is that the practice or the physicians are less experienced than the buyer. Increasingly in the healthcare world, most of the buyers tend to be very sophisticated buyers. They're either financial sponsors, such as private equity groups or family offices, or they're large consolidators, so very big groups. Like, for example, if you're familiar with the urgent care space, there's some really, really large urgent care companies in the suburbs and in the urban areas. And then also hospitals. For many healthcare verticals, the hospital is considered the terminal buyer, right? So what's the problem when you're selling to someone like that when you have no experience, right? Well, from the get-go is that there's an uneven level, there's an uneven playing field, right? The people that are on the other side of the transaction with you have more experience doing deals. Usually large consolidators probably acquired hundreds of practices. They have more resources at their disposal, not just in the form of capital and money, but also people and advisors. And so the question then becomes, how do you level the playing field, right? And so as M&A advisors, we help do that in 2 key ways, right? One is to educate the seller, because again, quite often this is the first time they've ever done a transaction like this. And then the second thing is to create a competitive environment or competitive process, that the whole goal of the process is to try to get as many offers as possible from as many buyers as possible, right? And so when you look at the stages of an M&A transaction, depending on who you talk to, there are anywhere from like 7 to 10 different things that you need to do. And I like to break them down into 2 distinct phases, right? One is, what do you need to do in order to get yourself to market? And the other one is, like, once your company's out there already in the market, what do you need to do from that point forward? And what you'll see is that depending on which phase and which stage you're at, you'll be working in different ways with different advisors, and the consideration and the things that you need to take into account vary, right? So for purposes of this question, I want to explain a little bit about what is it that you need to do to go to the market once you've had a conversation with Erin, with Len, perhaps your CPA, right? And as others have alluded, it's basically 3 things. The first is to figure out what your practice is worth. And that's usually done either through something called the calculation of value or a full-blown valuation. Usually for groups that are looking to sell, a calculation of value is usually a little bit more affordable, a little less involved, but still gives you the range of values that your practice is likely to fetch. This is important because the number that results from that valuation or the calculation of value may not be enough for you to give up the business and retire. The second thing is, how do you tell your story? If you've ever been involved, sold your house, or gone into like a real estate open house, when you go in, you see there's this really nice little 1-pager that tells you a little bit about the house. Our world is kind of similar, but we produce something called a blind investment summary that at a very high level talks about the practice. It says, roughly speaking, where it is. It doesn't identify the city that it's in. It tells you a little bit about what their financial performance has been for the last few years. It tells you a little bit about the operations and the services that they provide. But the key document really is this a marketing book that we call the Confidential Information Memorandum that details everything about the business. And the idea behind this marketing book is that you're trying to provide enough information for a buyer so that they can make a very quick decision as to whether or not they want to buy your practice, or even before they even make that decision, decide whether or not they want to have a follow-up conversation with the seller. And you want to do that in a way that entices them to have that conversation, but doesn't reveal the secret sauce. And then the last step is, where are you going to tell the story? Again, using real estate as an analogy, if you were listing your house, you would just put it on the multiple listing service. But guess what? There is no multiple listing service for businesses, at least in New York. And so what you have to do instead is you have to rely on a combination of both online and offline methods to really get that story out. So some of the ways that you do that, there's a website called Biz Buy Sell and a few others of its kind that buyers are known to go to. There are proprietary databases such as Axial that usually buyers and sellers and private equity groups are part of that group. And then there are some offline methods. The problem with the online methods is that you're hoping that somebody happens to be looking for a practice of your type, your size, and in the given location that you operate in. And so that tends to be very passive. And so one of the things that we like to do is we like to employ some more like direct methods, if you will. And some of those methods include coming up with a buyer list of both strategic buyers, in other words, buyers that are in your industry, as well as financial buyers such as private equity groups and financial sponsors. And then we send them a letter, we follow up the letter with a phone call, and then we also do increasingly some email marketing and direct mail. So that at a high level is what, once you go through those three things, the idea is really to start to get multiple offers from multiple people. And once you get those offers, you really have to try to negotiate them, not just for a price, but also for the terms. And I'll stop right there because I know that as we move on to the latter phases of a transaction, due diligence and closing, we're going to talk a little bit more about that.
Thank you, Lou. And Lou, I'd like to come back a little bit towards the beginning of your remarks today. You were talking about the preparation work that needs to be done even before you go to market. And from our experiences, I know that can be time consuming, but if you don't put in the time at the beginning, it's going to be very difficult to sell, and it's going to be very difficult talking with prospective buyers. Can you talk a little bit more about getting sellers ready, helping them to put their story together so that they understand why they're selling, what their practice is, and everything? Some of your work there.
Yep, sure. So there's a few things, right? One is deciding whether you want to sell, right? And that's what we alluded to before. And I think the one thing that I would stress to any seller who's on this call is that most of the advisors that we work with, they have sellers don't reach out to them because they're afraid to incur costs. And what they don't realize is that in the vast majority of cases, most advisors will actually give you an hour of their time. Usually some of these advisors you're already a client of theirs. So if you have a CPA, you're already dealing with them month in and month out. Erin, you probably talk to her 4 times a year, right? You do during quarterly reviews. And Len probably helped you set up the practice in the first place. And anytime you had questions along the way. And so one of the first things that I like to stress is that these conversations should be had very early on, ideally with everybody in the room, or everybody in the room that you know, that again, you're not incurring tremendous cost and that where it doesn't get unwieldy. So that to me is the first step, right? And then in terms of how do you begin to tell the story? Well, as a firm, we do it in a few ways, right? One of the main ways we do it is we send clients a questionnaire. And the questionnaire asks them all about their practice. The intent is to try to figure out who are your key employees. In the case of healthcare companies, what does the payer mix look like? And is that a diversified payer mix? So for example, one time I'd been approached by a physical therapy practice, and when you actually looked at the payer mix of the practice, most of their business came from a commercial Medicaid carrier. And it's not a problem. The problem was that that carrier had closed its panel and wasn't allowing anybody else to participate in that. And so how do you sell your practice to somebody when 35% to 40% of your business is coming from a couple of carriers that are no longer admitting new providers, right? We also try to figure out who some of the key employees are in the firm. In the case of healthcare services, the service is being provided primarily either by physicians or physician extenders, nurse practitioners, PAs in the case of medical, and in other practices by other mid-levels, right? Well, do you have a non-compete with some of these people? Who are some of the key ones, and are they willing to stay on, right? And then the last thing that we try to focus on in the book is the information that you can't glean just by looking at a website. So when somebody gets our marketing book, they see the name of the practice, they see the name of the owner, and they even see their website. And so one of the first things they do is they go onto the website and try to figure out, okay, these are the services they provide. But remember, no one reveals the secret sauce to the rest of the world, right? And so one of the things that we try to do in the book is to figure out what is driving value in your practice and what are some of the things that need to be improved in your practice, because no small business is perfect. Everyone has things that need to be improved. In fact, if you're selling to a larger group, one of the reasons you're usually selling is because they can provide you some relief from some of the difficulties that some of the smaller groups play. And then the last point that I'd make here is that I often ask the question, if you could flip sides, right? You've owned your practice for 20 years, 25 years, and you're about to sell it. But what if you could change roles and get on the other side of the table and now become the buyer for a few hours, right? Why would you buy your business? And why would you not buy your business? And the answer to those two questions, I think, create a very compelling story that a prospective buyer can use to make a quick decision as to whether or not they want to move forward.
You know, Lou raises so many important points there, but if I could just latch on to a few, you know, if it wasn't clear from what we've been saying already, or especially what Lou just mentioned, selling your practice or acquiring a practice, not only is it important to have advisors, but have the right advisors, right? So if I'm dealing with the client, you know, I try to impress upon them very early in the relationship, use me as a resource, not just for my legal skills and legal acumen, but in finding other advisors for a particular transaction. Because, for example, the accountant that you may be dealing with, that's dealing with your taxes year in and year out, they may not be built, or their firm may not be built to handle a strategic sale or acquisition transaction. Just like there are all different specialties of physicians, doctors, there are different specialties of lawyers. The world is too complex and healthcare is too complex just for one advisor to know everything, right? So doing healthcare like all of us do, the good ones, we tend to be connected with each other and know through a vetting process who's good and who to bring in. So at the best, this saves you a lot of time from doing your own searching. You're busy running your own practice with the myriad, you know, healthcare and clinical concerns that you have. Lean on us to be able to bring in other resources, other advisors. And why is that so important? Well, just because specifically, if you're talking about an M&A deal, M&A is incredibly complex, even in a non-healthcare setting. But now you're adding that extra regulatory and business and financial framework that are specific to the healthcare area, and it's a whole other level of complexity. Some of the things that Lou mentioned, you know, with regard that are only specific to healthcare. Healthcare is, you know, the payer mix, some other types of issues that other businesses, non-healthcare businesses, wouldn't have to worry about or wouldn't be concerned with. Being able to see these potential problem areas down the road, that's something that only advisors that are experienced and trained and have seen a lot of these situations, hundreds of them, these types of transactions, that's something where the value to dealing with these advisors is invaluable. And if you don't have advisors with that healthcare experience, a lot of times you won't know there's been a mistake or a big problem until it's too late. So it's paramount to have the right experienced advisors on your team.
Thank you very much, Len. I'd like to go back to Erin, if I may. Erin, can you talk a little bit about the role that a financial advisor can and should be playing during the transaction period, the kinds of conversations you have with your clients as they're going through this?
Sure. Thank you, John. And I just wanted to touch on one other thing that Len and Lou had said, right? The first thing that I'm really there to do is coordinate all of these pieces. I call myself a holistic financial advisor. Yes, the assets and the investments, right, are a crucial part of planning, and especially in the exit planning. But there are so many other pieces, right, gaps and threats that I want to make sure that we are coordinating all together. A lot of practice owners are trying to do the due diligence on their own, or lack of, right? They don't know where to turn, or they're only speaking to their CPA, right? Or only speaking to an attorney, right? So I'm really there to help them build, again, I draw out a wheel model, right, of other trusted advisors who are sitting at the table with them. So the first thing that I do with a practice owner is actually what I call a protection audit, right? Before we even get into the 8 ways to exit a business, I want to make sure, right, from a protection standpoint in terms of cash flow, a lawsuit, key people in the practice leaving or walking away, that all of those gaps and threats are identified and are not going to jeopardize the exit process. So the first thing that I want to go through is a couple pieces that I touch on in this protection audit. So one of them being making sure that our key people within the practice are properly protected, right? Having the right, insurances in place on them. There's also a policy called a business overhead expense policy I want to make sure is covered on the practice. If the practice owner is disabled, a business overhead expense policy will cover everything from rent to payroll to group health insurance to day-to-day expenses for the practice, right? Because if those components are jeopardized from sickness or injury from one of the practice owners, that could completely ruin the value of that practice. So I want to make sure that is identified right off the bat as well, right? We might look to key person life coverage, right, on certain key players within the practice. As Len had said, right, making sure non-competes are in place. Are they clear and concise to those people within the practice? I also want to look for one really important legal document, and that is a buy-sell agreement, right? And that is going to identify how the two partners, if there are multiple partners of a practice, right, walk away, or what happens if one passes prematurely. And I want to also identify how that agreement is funded. Sometimes I've seen practices have them in place and they've never been funded, right? So identifying whether that's going to be through looking into loans, right, or certain assets or insurance vehicles to fund that, and making sure it's up to date, right? If it hasn't been looked at in a decade or two, right? Making sure that the documents and everything's up to date as well. So that's the first thing that I walk through with these practice owners is, are we protected right off the bat, first and foremost?
Thank you very much, Erin. Okay. Len, let me just swing back to you. Len, I've seen practice owners that we've worked with. Some are superbly organized. Some are going to this and they can't find anything. They have nothing. Can you tell us a little bit about what you think sellers need to do to get ready as part of their decision making and as part of actually going forward looking for buyers? What do you think they need to be doing to get themselves ready?
Right. So this is a really, to make a car, a mechanic analogy, this is a real looking under the hood, because, when you're going into due diligence for a transaction, for a sale transaction, the other side is going to have their attorneys, and they're going to make a very detailed and comprehensive investigation, in other words, due diligence into various areas of your practice. So they're going to look into financials, taxes, overall financial strategy, and legal documents as well. And one of the big things, because I represent both sides, acquirers, purchasers, as well as sellers, so I know what the other side looks for. When you're looking at agreements, some of the big things that I look at are some of the things that Lou and Erin mentioned earlier. Okay, for key employees that we want to keep on, key positions, one thing that the purchaser wants to make sure doesn't happen is when they buy the practice, that the key people that make that practice what it is, that they bolt and go somewhere else, because there goes a lot of value out the back door. So how do we do that? From a legal perspective, we look at those contracts. You have to have written contracts for your agreement for your employees, your physicians, and your staff. Not only because it's a good idea from an employment management perspective, but also legally, healthcare wise, it's essentially illegal if you don't have those in writing with your key healthcare employees. So that's another area where you may be able to get by a business owner in a non-healthcare setting, but healthcare settings, you have, even more stringent regulations there. So that's one of the things, that if your agreements with your key people aren't up to snuff, that's where you really need legal counsel looking at them right now to be able to identify those things, ideally before the purchaser's attorneys identify them, and you don't want to be caught unawares by that. Structuring of your practice, the documentation, corporate documentation, like for example, if you have a corporation, professional corporation, documents such as your bylaws, your corporate resolutions, and these may be things that that you may have prepared at the beginning of your practice, or prepared with another attorney. If I haven't prepared them for a doctor, they may have had a previous attorney before me or came over to me. That's one of the first things I want to make sure that they have lined up. And while those documents may seem like less important, more of administrative documents to have, they become critical when you're looking to sell your practice, because what the purchasing attorneys want to make sure of is they want to make sure nothing in those documents prohibits the transaction from going forward. And especially if they have an outside financer, a third-party financing, a bank or whoever coming in, that's critical. The bank's going to want to make sure that all these documents are in line, and that there's nothing that the transaction will potentially run afoul of any of those documents. If there is, then that could hold up the transaction and at worst potentially scuttle it if you've got a really eager buyer that wants to close within a certain amount of time.
Thank you, Len. And now, Lou, I'd like to turn back to you to talk a little bit about strategy and how we in the M&A field work with practice owners on developing their strategy for selling their practice.
Yeah, so I actually think that strategy is one of those areas that almost everybody gets wrong. When Erin was speaking, and she was talking about how she helps her clients, I remember there was a part very early on in my career where a financial advisor had actually referred me to one of their doctor clients. And so we sat with them, and this particular physician asked me, well, how do you go about selling the practice? And I walked them through it, and they learned a lot. I learned a lot about them. And at the end of this conversation, they looked at their financial advisor and they said, can I sell my business? What do you think? And the advisor said to them, you know the answer to that question. You can't afford to sell. You need to hold on to this a little bit longer. And as sad as that news was in that particular case, that's actually probably one of the few clients that I've had that did it the right way, where they actually consulted with their advisor right from the get-go. And before they even went down the road of spending a lot of money, they really assessed, how is this going to look like for me, not just from a professional standpoint, but also for a personal standpoint. And I guess having worked as a financial advisor for a number of years, I think that's another part that people get wrong, that everyone gets hung up on the price. So if somebody offers you $5 million, is that a good number? If they offer you $10 million, is that a better number? Clearly in absolute terms it is, right? But that fails to take into account what their personal financial situation looks like, what their tax situation looks like, and then beyond the numbers, it also fails to take into account how is their world going to change when they sell. If you're talking about ambulatory practices, oftentimes a physician is usually the king or queen of their domain, and they're very, very involved in the lives of their patients. They get a lot of value and a lot of satisfaction from that. So when you go to sell and you're no longer doing that job, how are you going to react? So there's this qualitative aspect to the strategy that often doesn't get taken into account, right? The other thing is, I find that sometimes right before they come and speak with me, they do or take a series of actions that actually wind up hurting them when they go to sell. And so I don't know if these are strategies or whether they're tactics, but these are things that I would encourage everybody not to do, right? The biggest one is they cut back on their hours. And that's understandable, right? We haven't mentioned this throughout this whole conversation, but there's this thing called COVID, right? That we've all lived with under the last 2 years. Well, before COVID, if you were to ask a physician why they were looking to sell, they would almost always tell you that they loved practicing medicine, but that they hated the business side of medicine. Medicine and healthcare has become so complex. And if you're the physician owner, you not only have to be an expert clinically, you have to be an expert administratively, from a marketing standpoint, from an operational standpoint, and no one person in this world can master all those different domains, right? And so understandably, they hit the point where they're like, I just can't take this anymore. I'm going to retire, right? And so they tend to reduce their hours. They cut their hours from, let's say, a full-time practice to like 20 hours, and they don't realize you just basically cut the value of your practice in half. Because in our world, when people go to consider what they're going to pay for your practice, they're not going to take where they will take the future into account, but they'll also take into account where are you right now. And if you just cut your practice, that's a problem, right? Another mistake that is often made in our world is that there's this tendency to view the buyer as just being one buyer. So, for example, when I ran my urgent care centers, I approached a physician one time and I said, hey, I want to buy your practice. And they're like, no, I'm already talking to the hospital. And I'm like, well, don't you want to talk to me too? And they were like, no, like, I just want to talk to the hospital. Would you do that in your world? Would you just, if you were looking for a job, would you just speak with one employer? Right? You obviously wouldn't do that, right? Why would you do that in the practice? The other thing is that sometimes people aren't aware that the buyer is not just a hospital, is not just one or two different types. It could be more. If you take urgent care, for example, there are like 5 different types of buyers in the urgent care world, right? There's big consolidators, there's insurance companies, there are hospitals, and increasingly, there are also multi-specialty groups. You could be a practice that's operating in New York, and you take a look around your catchment area and see, okay, this is the universe of practices that could buy me. And you actually could be very wrong because you fail to take into account that there are other buyers in other parts of New York State or other areas of the country that might be interested in making a foothold in the location. And then also there's this tendency to get hung up on price. And I think that's a mistake. We haven't talked about that yet in this webinar, but I actually think that the terms are way more important than the price. And when you look at the terms, I'll leave this for Len to talk about it a little bit. The terms could be legal, right? So like, what does due diligence look like? Is this transaction subject to an earnout or another contingency payment? Will there any money be held back at close for regulatory risk, right? Len alluded to this before. Will there be an employment contract? How will it be structured? If you own property, which in many cases the owners of ambulatory practices also own the real estate that they operate in, how are you going to structure the price for both if you actually happen to be selling both? And not technically a term, but I'm calling it a term. It's like how are you going to add value and get along with the people that are acquiring you? Increasingly, the groups that are acquiring you tend to be large groups. Well, what does a large group need? Step back a minute and think about that. If I'm operating an urgent care center in 50 locations, 75 locations, and I'm the primary physician owner of that, if that is even the case, how can I supervise 75 different locations? I can't. I need you to actually help me supervise that. And maybe I even need you to supervise other practices if I'm willing to stay and expand in your area. And so the question becomes then, are you willing to help with that? So, how is the relationship between the buyer and the seller going to be once the dynamic switches and the seller goes from being the operator to being the employee? And I'll stop right there so that we can ask additional questions.
Great. I also want to have Len comment on something you said, which I think is important. A lot of times I've seen this also where a seller is focused very much on the offer, how much money they were offered, and not on the terms and exactly how do the terms say they're going to get that money. Len, could you talk a little bit about that and about the reviews that you do, your clients' understandings, and all of that?
Absolutely, John and Lou. So yeah, I mean, and it really illustrates again that all of these areas, financial, legal, tax, they all blend together. They're not, when you look at these, they can't all be looked at in a vacuum for the most part, because so there are a number of different ways just from the financial standpoint to structure one of these deals. And many times when we're talking to physicians, when they say, oh, how do we structure this deal? They mean the payment terms. But when you look at it, like Lou indicated, structuring of a deal goes a lot deeper than just the payment terms, right? But if we are just to look at the payment terms, there are a number of ways that can be structured, right? Obviously, that can be the simplest way would be that be paid all up front, but that all 100% be paid all up front at the closing table. That almost never happens. There's different types of structuring for different reasons, especially in a healthcare transaction. So, for example, it's typical that the seller would receive some amount up front. The percentage varies, 50%, 70%, whatever, but then also other amounts, there be conditions on those. So a couple of things we're talking about that Lou mentioned would be escrow, sometimes called escrow holdback or just a holdback, and the earnout. These are two of the most common things. So an escrow holdback is basically where the purchaser says, look, we'll make it a nice round number right now. You're selling your practice. We're purchasing it for $1 million. However, there are certain regulatory concerns. Maybe there's not concerns, but certain regulatory issues that we found going through due diligence. There's potential liabilities. For example, there's a pending lawsuit or a pending medical malpractice suit or whatever that may or may not be meritless or not, but we need to hold that aside in case we, the purchaser of your practice, need to make a payout in the future. We want to have that money available. We don't want to have to come chase you, who's potentially sold all of your practice, and there is no practice to get that money from. It's safely put aside for that. So that escrow can be pretty large in a lot of cases. I know. For a transaction, I just recently completed a sale transaction for a podiatric surgeon. There was a medical malpractice suit that he was one of 20. His practice was one of 20 defendants that he probably was not going to have, according to his medical malpractice attorney, any liability on that, but the lender for the purchaser required that a certain amount be put aside just in case in the future they had to come after the practice for that. Another thing was part of the property that was purchased in some of the medical space, office space that was purchased as part of that transaction. The title company found a cloud on title that pretty much all the parties, I think, generally agreed it wasn't going to be a big deal to go ahead and move before the local zoning planning board and get that cloud on title removed. It was something from a deed from 20 years ago, but nonetheless, the lender required $50,000 to be put aside out of the purchase price to be put aside in escrow to make sure that gets resolved. And when and if that gets resolved, then that $50,000 or some or lesser amount would then be released to the seller. But the point is the seller's not getting that at the closing table. And then many times in these situations, the practice that the purchaser takes over for patient continuity and for other reasons, they're going to want the physician or physicians to stay on and be now not owners of the business, not owners of the practice, but employees of the practice for a certain amount of time, sometimes a year, 2 years. And it is a huge mind shift change that I find that many, not just physicians, many business owners are no matter how logically you can understand that you're no longer going to be the king or queen of the kingdom, and now you're going to be an employee. As much as you may realize that from a logical standpoint, actually in the practice of it, doing it, it can be a very tough pill to swallow. And they find that year or two of getting earnouts as part of the purchase price, that they feel like they work for every second of that, and even more so in the frustration. So these are all things that, are we talking about compensation? Yes, we're talking about compensation, but the way it's structured really delve into deeper issues. And again, where we haven't even begun to touch on other important issues, like is this structured as, for example, or is the purchaser buying the whole business in the form of stock, equity, or are they only buying certain assets and leaving other liabilities aside? And that can be a very complex question. And the better a physician's able to be prepared to answer that question by talking with their financial advisors and other M&A advisors beforehand to find out how much money they're going to need on the back end to retire, the better they'll be able to come at those, what can be very technical questions when it's time to make them.
Thank you, Len. We have about 10 minutes to go. I would really like to we've had 2 questions from the audience, and I'd like to get to those. I'm going to ask the questions, and panelists, please feel free to respond. First question: what role does a compliance expert play in the selling of a healthcare practice? So this is a compliance expert play in selling of a healthcare practice.
If I could touch on this a bit, John.
Thank you, Erin.
One of the aspects of that wheel of trusted advisors, one of the spokes is someone who specializes in cyber liability, right, or IT, because a lot of these healthcare practices, right, we have to think of HIPAA and patient information in there. So that is a spoke, right, touching on that compliance aspect of making sure IT is really buttoned up and different areas there to make sure patient information and again, non-competes, non-disclosures are identified and involved in that wheel.
I think too.
Another.
Yeah, go ahead.
Go ahead.
No, go ahead, Len, because I think the second question probably is more appropriate for me. So.
Sure. So not only what Erin was talking about, so that's one huge area. Another specific to healthcare practices is making sure that you're on the right side of federal and state Medicare and anti-abuse laws. So for example, this could be multiple other presentations, but for example, on the federal level, there's what's called the Stark Law, which and the anti-kickback statute, which essentially is against is a prohibition on self-referrals to the physician and payment of referrals tied to Medicare services. So what does that mean for these transactions? Well, there are certain types of things under these statutes called safe harbors, where if the transaction is structured in such a way, then it's more likely than not, or is definitively safe from being deemed violative of those statutes. And one of the many ways it can pass muster under those statutes, there are other things that need to be ticked off, is to make sure that the transaction is for fair market value. What is fair market value? Well, that goes into very detailed territory, and this is where having a valuation is critical. An outside valuation is critical to making sure you fit within that compliance. But that is a critical part of these transactions, making sure that they comply with those statutes, because what could be a great deal, a very savvy business deal in a non-healthcare setting, depending on the terms, could actually be illegal in a healthcare setting if it's not for fair market value and doesn't satisfy a number of other important requirements.
Another quick thing that I would add here, right, is that when you look at it, right, a big part of the value of the practice is driven by the net cash flow of the practice, and that in turn obviously results from certain revenue and a certain expense number. Well, a lot of the revenue comes from the services that are being provided, and when you look at that, those in the healthcare world, those are the result of each encounter being coded a certain way. So imagine that you're going to buy a practice and you're buying a practice that represents revenue of X, but when you actually dig deeper into all those visits, all of the visits were coded out at a level 5, let's say at the highest level of acuity. You might not be very comfortable buying a practice like that, right? Because you know that that's probably a problem that's waiting to happen. And one of the things that we really haven't touched upon is the extent to which like trust, the role that trust plays in transactions, right? Usually when I was in the business of buying practices, we would have a marketing person that would go out and ask physicians if they wanted to sell, and then they would bring me in and I'd start to get a little bit of a sense as to what they wanted to achieve. But very quickly, once I went back to the physician owners of the practice, they were calling all their friends to find out about the practice that they were buying. And they were like, do you know Dr. So-and-so? Do you know Dr. So-and-so? And so when really, like, when you boil down what selling a practice is, if you flip it around and say, well, what is buying a practice, right? Well, what kind of practice do you want to buy? You want to buy the practice of a physician that has a great reputation for providing quality service and care to their patients in a compliant way, right? No one wants to buy non-compliant practice, right? So that's kind of like the first thing. So there are a lot of people in our world that we can refer you to. It could be like, for instance, I know a coding specialist who will look at your, at your encounters and see whether or not there's a problem. But that whole issue of compliance goes beyond just coding. It really goes to are you following all of the regulations and are you doing things right? Again, the former owner of my practice, one of the things that they always said is good medicine is good business. But the opposite is also true, right? You can't have good medicine without good business.
Thank you, Len. And let me go to the last question. Given the buying and selling spree of the last years, what does the ecosystem presently look like? Okay. I would personally like to answer this. We're very busy right now, in a good way. We work with both sellers. We work a lot with buyers, and it is quite busy right now. There are many people who are looking to sell. There are people looking to buy, but there's also a large number of people I would term as being open-minded. They want to learn more about why they might want to sell or why they might want to buy. But I think right now it's very active. Lou, do you share that?
I do. The only thing that I would add to that is that it obviously depends on the sector that you happen to be looking at, right? Because different sectors or different verticals are at different stages of the M&A process. Like for example, if you look in the primary care world, hospitals have been buying those for well over 10 years, right? And so oftentimes when you go looking for practices to buy in primary care, the good ones have already sold. But there are other specialties in healthcare that's also the case, where there's a lot of, for instance, hospitals have made a lot of acquisitions in the cardiology space. And so if you're looking for something to buy there, it's a little tough. But in other, and then in other areas, like for instance, urgent care is probably in the middle of the cycle. Ophthalmology, there's been a lot of activity there in the last few years. There's been, I know, Erin, you specialize in physical therapy. Those have been consolidating for quite a while. So it depends, I think, to some extent on what the vertical is. But when you look at the things that have been driving healthcare consolidation, many of those still exist today, right? So one is healthcare reform. When you look at whether it's the Affordable Care Act or other reforms that have been put in place, they're all about encouraging consolidation in many ways, right? So that's still there. The fact that physicians are looking for assistance and are getting a little bit tired of running their own operations, that still exists. The fact that they operate in very fragmented markets, for instance, many of these, the healthcare services world still consists of what we call onesies, twosies, so one location firms, two location firms. And those are great firms for a potential acquirer because they could buy them at an affordable price, package them and sell them upstream at a much higher multiple. So there are opportunities for that. The last thing that I would say here is that activity in any sector is also impacted by the greater macroeconomic environment. And for the last 15 to 20 years, that's been really good. But there's some concern, recently regarding what the level of interest rates will be going forward, whether or not we can sustain a strong economy going forward. And those concerns, I think, have decreased M&A activity in the healthcare space a little bit in 2022. But I don't think that, for at least for the foreseeable future, for the next few years, that's going to significantly impact the world that we operate in the lower middle market and the middle market, because again, many of the conditions that were there pre-pandemic are still there, and the need and the advantage of consolidating, I think, still exist.
Thank you. And I noticed that our hour is pretty much up. Excuse me?
I don't know if Erin wanted to say something.
Really quickly, I just wanted to touch on one point that Lou brought up. And a lot of things that I'm seeing with practice owners, right, is that the assumption is we can only, sell to the next generation, right, or an outside party. And there are so many other paths a practice owner can go down, right, either an ESOP or an IPO, becoming a passive owner, still retaining ownership, or liquidating. So I think exploring multiple options, right, even giving today's ecosystem is valuable to healthcare practices. I'm sorry, John, go ahead.
No, thank you, Erin. Okay, as I was saying, our hour's up. One of the conclusions I drew from today was that all practice owners have some level of advisement already. They may have financial advisors who advise them and guide them through their career and their practice. They have attorneys who even help them to set up their practices in the first place. They have accountants. So they have those pieces, and all of those people, plus the remaining members of the team, can help them first in the decision, should they sell their practice? Then moving on to telling the story of their practice, and then preparing their practice for sale, and then taking their practice through every stage of the transaction towards selling their practice. That has been my big takeaway from today. I would like to thank our three panelists. I think it's been a great conversation, and I hope for the audience and for those listening later that you get a lot out of this, and have a good afternoon, everyone.
Thank you.
Thank you.